afternoon, and thank you for joining us for this simulcast on year-end tax saving strategies, where we're going to talk about solo 401ks. So we started a new platform here at Advana IRA, where we're doing both a live presentation at our office and we're also hosting it as a webinar. So for those of you that aren't here in the office with us today, I just want to let you know that we do also have a live audience. We are going to be accepting questions both on the webinar and in the office. So that's kind of what you're going to be hearing as we go forward during the simulcast. So just as a reminder, if you're on the webinar, if you're logged in with us today, you can go ahead and type your questions into the question box and we'll make sure to get those answered as we go. My name is Larissa Green. I've been with Advana IRA for 8 years, and I've been doing marketing, education, and business development for 6 years. Prior to that, I was involved in a lot of different aspects of the company, including check coding, opening new accounts, handling transfers, and I did some transactions as well. If you're a client of ours, you know a lot about how that process works, and we'll talk a little bit about how that works today as well. We are a self-directed retirement account third-party administrator. So what that means is we can hold qualified funds for any type of retirement account. We'll talk about that in just a second. But really who we are is an administrator to help you find those investments that you want to make outside of the market, hold the accounts for you, you find the investment, and then we help you make sure that it's properly titled in the name of the IRA or 401k account, and we do your IRS reporting. We have 2 offices, but we can work with anybody nationwide and worldwide. So if you're not familiar, we're located in Largo, Florida, and Atlanta, Georgia. And then, like I said, we really can work with anybody who has a US-based retirement account. And we've been doing this for a little over 15 years. And actually, I do need to update my slide here because we have around just over $1 billion assets under management with us now. We're at about 7,000 clients. And so we've grown a lot over the last several years. You can always check out any of our events by checking out our event page at advanaira.com/events. You can go to our learning center where you can check out webinars, or it's just as simple as going to YouTube, searching Advana IRA, and we do save all of the recordings for all of our webinars to our YouTube channel as well. And this one will be up there also. And it usually just takes about a day or so for us to get it posted. But then if you're interested in going back and listening to it again, you'll have the ability, or you can share it as well. Something that we don't do, although we'll talk a lot about different types of accounts, the rules involved for those types of accounts, and different investment strategies we see, we do not give legal, tax, or investment advice. So that's something to remember when you are talking to your Advana IRA account manager. So your account manager will help you the best that they can, but if you ask them something sort of out of our scope of work, they will refer you over to a professional that can answer your questions. So if you have questions about something and whether or not it'll fit into your retirement account or if it's within the rules, we can certainly help you understand the rules and how they work. But if you ask us, is this a good investment? How should I structure this investment? We're going to refer you over to an attorney or maybe a CPA that can help you. So when we talk about solo 401ks, a lot of times it seems complicated, and at times it can be, but really the important points that you want to take away from this presentation today are that sole proprietors and independent business owners qualify even when they're not incorporated. So I think that's very important because a lot of investors that I meet say, well, I don't have, an LLC, I file as a sole proprietor, and that's okay. You can still qualify for a solo 401k. 401ks are the only type of plan that allow you to commingle traditional and Roth funds in the same account. And 401ks can easily be self-directed and have checkbook control. So those are 3 very important points on these types of accounts. And so as I go through the rules and the strategies for 401ks, just keep these in mind as we go through. So what is an employer-sponsored plan? Well, that's a really important point of this webinar because we're talking about really taking advantage of making contributions to a 401k, and it's really easy to do. The biggest thing for a 401k is that you have to have earned income. So I know a lot of times we have rental income and interest income from mortgages, and those are not going to qualify for making contributions to a solo 401k. But it is possible if you have earned income to qualify for a 401k plan. And basically what that means is you have a plan established by a company, and again, you can do it as a sole proprietor at little or no cost to the employees. It's important to mention here that you have, you get to wear both hats when you have a 401k plan. So if you're a sole proprietor, an independent business owner, and you have no employees, you would qualify for a solo 401k. When you establish a solo 401k, you are both the employer as well as the employee. And that's going to be important when you talk about making contributions to the plan, who is the trustee and administrator of the plan, and a few other points that we'll go through as we go through the seminar. But so the plan would be established by the sole proprietor or the entity or business. The plans allow for larger contribution limits than traditional or Roth IRAs on an annual basis. And most of the time, especially in a solo 401k, both the employer and the employee can make contributions to this account. So it's a great account when you're trying to save for retirement. And I know a lot of times, when we're self-employed, it's harder to put money aside. When you have, I work for Advana IRA, we have a 401k plan, and they encourage us here to save for retirement. They do a match, they set up the plan, they make it very easy to participate. But when you don't have somebody helping you with that and encouraging you to do so, it's sort of at the bottom of your list. And so with something like a solo 401k, you can really make those contributions, put a lot more away on an annual basis, and start saving for retirement. And 401ks, solo 401ks have been allowed since 1974. Prior to that, pension plans were the way that people were saving for retirement, but a lot of companies didn't offer pension. And so the passing of IRAS opened up 401ks and IRA accounts. And so if you're not taking advantage of that, look at what you're working on for the end of the year and really consider the solo 401k. So key components to employer plans, of course, again, the business, and again, if you're a sole proprietor, that's okay too, but essentially somebody has to sponsor the 401k plan. And so when you complete an application to open a 401k, we're gonna ask you who's sponsoring it. And so it could be you as a sole proprietor or your business. The participants are the employees. So as an employee of Advana IRA, I am a participant in the 401k plan we have here. And contributions, we want to know who they're coming from, whether it be employee or employer, and whether or not they're going to be pre-tax, traditional, or Roth contributions. And we'll talk about that in just a second. So I like to show this slide because it really sort of outlines the differences between the types of plans and where the benefit to the 401k comes in for sole proprietors. So you can see with a traditional or Roth IRA for 2019, you can contribute $6,000 or $7,000 if you're over the age of 50. And that's great, but if you're saving for yourself and you don't have an employer helping you do so, you really want to maximize your contributions. And so you can see here that the 401k plan actually allows the most in contributions. And although a SEP IRA does have the same limit, 56,000, the formula that they use to arrive at that 56,000 is different for a SEP and a solo 401k, ultimately making the 401k allow more in contributions on an annual basis. And it also does allow an over the age of 50 catch-up of $6,000, which the SEP IRA does not. So the solo 401k really it has the largest benefit for making contributions, and it also has the most flexibility, which we're going to talk about. So who are they for and what are the benefits? Well, we talked really briefly about a SEP IRA. There's also a simple IRA and a 401k, and these three types of plans are for sole proprietors and independent business owners. With a SEP or a simple IRA, those types of plans will work if you have employees. So you're not qualified for a 401k, if a solo 401k, if you have eligible employees that may be allowed to participate. You certainly can have a more traditional 401k plan, but the solo 401k plan is really for business owners and their spouses as employees or partners only. If you have employees, you have to either look at a larger 401k plan made for those types of businesses, or you could consider a SEP or a simple IRA. The benefit, of course, being the larger contribution limits and the flexibility of the contributions. And then a big benefit of the 401k is going to be the ability to contribute to what people consider a Roth 401k. So where do contributions come from for the 401k? Well, again, and it's important to note that it does have to be earned income. So if you own rental properties and the only income you have right now is rental income, that's going to be considered passive, and that won't count towards your contributions. So passive income is not going to make you eligible to make those contributions. Now, certainly if you have an entity set up, your rental income goes there and you pay yourself a salary from that entity, you may be able to make contributions to the 401k, but you do have to have earned income. And the different types of earned income that would qualify would be Schedule C or F. Some K1, it's going to depend on the K1 where you're entering that income, which box you enter it in as to whether or not it's earned. W-2, of course, and 1099. So again, it's going to be something that you want to talk to your CPA or your tax professional about, but finding out what type of earned income you have prior to setting up a solo 401k. So there's a lot of things that I think are appealing to the solo 401k plan. And a big thing for the solo 401k is your flexibility in making contributions. You do not have to contribute every paycheck, or when you have the earned income, you do not have to contribute on a monthly basis. You even have the opportunity, as long as you have your 401k plan established, to contribute into January and all the way up until your tax filing deadline, plus extensions for one side of the contribution. So, and I'll talk about how the contributions work. But for example, if I establish my solo 401k plan before December 31st of this year, I can make my employee contribution into January, and then my employer contribution can be made all the way up until my tax filing deadline, plus extension. So that's important to note, because a lot of times you're still working on your taxes going into the next year, and you're not exactly sure how much you're going to want to contribute. So there's a lot of flexibility there. The other part of a solo 401k that I think is a huge benefit is loans to participants. And I actually just helped some friends set up a solo 401k, and they could not believe that they could borrow from the solo 401k and use that money any way they wanted. So an IRA does not allow you to borrow money for yourself. It's just strictly not allowed. But with a 401k, whether it be through a large company or a solo 401k, does allow plans to, or loans to participants. And so that means that I can take money out of the 401k in the form of a loan. You do want to be aware that it is a structured loan. You do have to pay it back. There is an interest rate established, and it does have to be paid back in a certain amount of time. But you can borrow $50,000 or 50% of the value, the lesser of the two, personally, and use that money for whatever you want. So, none of the other plans allow that. I think it's a huge benefit. Another benefit to the 401k is that you can make contributions on the Roth side of the 401k, meaning that essentially when you're looking at a 401k, it has two buckets. Bucket one is going to be pre-tax or traditional type dollars, and bucket two is going to be Roth or after-tax money. And those contributions can be made any way you like. So when you make your contribution, the employee contribution has the ability to be designated as Roth. And if you allow it in your plan, when you make the contribution, if you put in employee contribution money and you decide this year you're going to make it Roth designated, you certainly can do that. If next year you decide you'd rather have the deduction for making contributions, you can do that as well. So you have a lot of flexibility there. And we had a question pop up.
What if I have two jobs and have a retirement plan with my employer? Will my solo 401k get private?
So that's a great question. And so for those of you that couldn't hear it on the webinar, the question is, what if I have two jobs? One of them essentially being a W-2 and the other one working for myself, is my solo 401k contributions going to be limited? And the answer is yes. The employee contribution is across the board. So I'll use myself as an example again. If I'm contributing with my 401k through Advanta, my employee contribution can be up to $19,000. If I also have my own business outside of Advanta, then my $19,000 contribution is going to be per individual, meaning that I can't contribute $19,000 with Advanta and then $19,000 through my solo 401k. It's going to be total. But the employer contribution is per 401k and is based on a formula of your earnings. And so you'll want to look at your earnings and have your CPA calculate what you would possibly be able to contribute for the solo 401k. That's a great question. So I mentioned that there are two buckets for the contributions in a solo 401k. And remember at the beginning of the seminar, I mentioned that the 401k is the only plan that allows you to commingle pre-tax and Roth money in the same account. And that's a huge benefit because you're going to get a lot more options and you can contribute Roth money at a much larger amount on an annual basis if you choose to do so. So this slide basically represents those two buckets. And remember that you're both the employee and the employer in this plan. What that means to you is that when you make an employer contribution, the deduction is going to be for you as the employer. When you make the employee contribution, you have the ability to either do it as a pre-tax contribution or as a Roth contribution, or any combination of the two up to the 19,000. And so, let's just very simply take $100,000 in earnings. What that means is if I make $100,000 this year and I contribute as the employee, I can put that 19,000 in. But as my own employer, let's say I could contribute 20%. It's going to depend on how you file. But then I would get another $20,000 into my 401k. Now I could have $39,000 total pre-tax money in the 401k, or I could have 20,000 in pre-tax money and 19,000 in Roth. So there's kind of an example there for you of how that works. And I have on the employee Roth question mark, because again, you don't have to contribute to, you don't have to decide that you want it Roth. You can have pre-tax contributions as well. And it's 19,000 plus, because don't forget, with the solo 401k, you do get the catch-up amount of 6,000, and that is on the employee side. I had another question pop up. So the question that popped up is, can you set up a solo 401k if you're receiving guaranteed payments from a partnership? And the answer to that is yes. But you want to check with your CPA on the contribution amounts for that. Another question? Oh, that's a great question. So the question for the benefit of the webinar is, if an individual is over the age of 70, can you still, and is still working, can you set up a solo 401k? So a little bit of background on that for those of you that don't know. If you're over the age of 70 and a half, which is considered required minimum distribution age and to the IRS, meaning that once you reach 70 and a half, if you have a pre-tax account, the IRS asks that you take a certain percentage out of your account on an annual basis. And so typically with like a traditional IRA, once you're over the age of 70 and a half, even if you're still working, you can no longer make contributions because now they want you to take that money out. And it's based on a percentage, it's based on your life expectancy and the value of the account. But with a solo 401k, if you're over 70 and a half, you can still make contributions as long as you have earned income. You will still have to take a required minimum distribution each year, but based on the percentage versus how much you can contribute, I still do feel like there is a benefit to you there. And the percentage starting out with required minimum distributions is pretty low. It's around 6% more or less. It's going to increase, of course, over time, but you would still have the ability to make those contributions. And of course, you can always grow the account whether or not you're making contributions. So I brought us back to the contribution limit slide for 2019, just again, so you can kind of compare what the different accounts allow and what we went over. The contribution limits do occasionally go up for a traditional and Roth IRA, but they do go up every year for the 401k. So again, another advantage of the 401k is it's ever increasing. If you're making contributions into the new year for the previous year, you always want to check to see what your contribution limits are going to be, because they do change. So they'll stay for 2019, this is what they'll be, but when you go into 2020, I'm sure they'll go up a little bit. And so if you're making a 2020 contribution next year, check to see what they are. But again, if you want to make contributions for 2019 into a solo 401k, you will have to establish the plan before December 31st. As long as you do so, you'll be able to make your contributions as the employee into January, and then as the employer up until your tax filing deadline plus extensions. Another note about contributions, remember that they're going to be limited to the specific amount the IRS tells us. So on an annual basis, you can take money out of your pocket and put it into your 401k, or from your company into your 401k based on the limits on the previous slide. But when you're making investments, the growth is unlimited. So, a lot of times people will ask me, well, if I put, rental property in and it's earning $2,000 a month in rental income at the end of the year, I'm going to already exceed the amount I can contribute as the employee. But because earnings are unlimited, you don't have to worry about that. So, you have a great investment, it has great earnings, it's not taking away from the amount you can contribute. I'm going to talk very briefly about the different types of investments that you can make. With a self-directed IRA or 401k, there are a lot of options available to you. And as a matter of fact, there's only two types of investments that you can't make in a solo 401k or IRA. So the IRS has really not given us as much clarity as maybe we would like on the investments. But basically what they've said is, here's a list of investments you can't make, and it's very short. And here are the people you can't transact with. And then outside of that, just about the sky is the limit for 401ks and IRAs. And so that's a great thing for us, because when we're looking for non-traditional assets, we really have a lot to choose from. And I always say, no matter how many people are in the room, we could go around and each come up with an investment idea, and it's very likely something for your 401k or IRA. And so that just sort of gives you an idea of really how many different types of investments are out there. And I would also like to say that we've seen our clients get very creative and make some very creative investments. And on a regular basis, somebody will ask me about an investment that I've never heard of that, yeah, that would qualify for the IRA or 401k. And another big benefit of self-directing is investing in what you know best. And so not all of us know the stock market that well. We don't follow it. We don't want to be invested in it. And so being able to invest in the things that you deal with on a daily basis are a huge benefit to you, because you really understand those investments. And so I just have a few things listed up here, but as I mentioned, there are so many things that you can invest in. At Advana IRA, the number one investment we see in solo 401ks and IRAs is real estate. It makes up for about 30% of the assets that we hold. That other 70% is a myriad of other types of investments, but real estate is the most common. I probably talk to 30 or more people every week about investments they're planning on for their retirement account. And out of that, those 30, 28 of them are going to be asking me about real estate. That's just a very common investment. We also see a lot of notes and mortgages, and I think people like the idea of investing in real estate, but maybe they don't want to be worried about tenants, toilets, and termites in their retirement account. And so maybe they lend money on somebody else's rental property or rehab project. And the great thing about being the bank, as we like to say, in a self-directed retirement account is you get to establish all of the terms, and we actually do a completely separate presentation on that. So if you're interested in learning more, you can go to YouTube and search Advana IRA to check out that webinar on being the bank. But basically, when you go to a bank and you ask them to lend you money, they're going to look at you and determine how much they're willing to lend and what type of risk they feel that you are. And then based on that assessment, they're going to say, we are willing to lend you X amount of dollars at this percentage interest rate. And so when you're the bank with your retirement account, you get to do exactly the same thing. You get to determine the rate, the terms, and another great thing is you're basically determining the rate at which your retirement account is going to grow. So if I'm willing to lend money at 10% and 2 points for 6 months, then I know as long as my borrower is paying, that is what I'm going to have returned to my retirement account. You can use a single member LLC. You can use it for checkbook control of an IRA, or if you just like using LLCs when you're making investments, a lot of times into real estate, you can certainly do that as well. You can use trusts. They can be land trusts or personal property trusts. Of course, you can invest in real estate trusts as well. Private placements and private stock, that's another big one we see here at Advana. Keep in mind that brokerage firms have just basically made a business decision not to hold private investments. They don't want the fiduciary responsibility. They consider them hard to value. And so we really sort of fill the gap in the industry for those types of investments. And so we can certainly help anyone with those. We see a lot of foreign currency exchange here at Advana, and those types of platforms, they are willing to allow IRAs to invest, but they simply don't want to handle the reporting for IRAs. So they allow self-directed IRA accounts to open a profile on their trading platform in the name of the retirement account, and then they give access to the retirement account holder to do that trading, and that's the same with futures trading as well. So here's some of the more normal investments we see, some of the less common investments we've seen, things like movie projects and farm animals. I've had clients invest in things like racehorses and cattle. We've had people invest in breweries and restaurants. And so there are just so many different things out there that we see people invest in. Just really briefly, I want to talk about the consideration of leverage in a solo 401k. So if you've been to our seminars or webinars before, you've heard us talk about leveraging and how, yes, an IRA can have debt when it's purchasing real estate. That is possible, but there are some moving parts that go along with debt financing in a retirement account. For an IRA, one of those moving parts is a tax called UBIT or UDFI. And so what that means to an IRA account holder is that, yes, they can have financing, but the financing is going to expose the IRA to a tax, and that tax is directly related to the amount of financing. But in a solo 401k, when you're making a purchase into real estate and you're using financing, as long as it's for purchase of the property or if it's for improvement of the property, UBIT or UDFI does not apply. So that tax actually does not apply to the 401k like it does the IRA. And so that's very important to know, because if you're considering financing in an IRA, you'll have to go to your accountant and talk to them about calculating that tax. But if you're doing it through a 401k to purchase or rehab a property, that tax is not going to apply. If you've been to our seminars in the past, you've also heard us talk about non-recourse financing, and that does apply to the 401k. So no matter what type of retirement account you're using to make these investments, if you use financing, it does have to be non-recourse. If you're not familiar with that term, that basically just means that you're not signing a personal guarantee or extending your personal credit for the purpose of the retirement account. So when I go and apply for a loan for my personal residence, I'm signing a personal guarantee. They're going to look at my credit. They're going to establish terms based on my credit and myself as a person. But when I go and apply for financing for my retirement account, they usually will do something like a rental analysis, and they really base their considerations on the property itself, because basically in non-recourse financing, the entity or institution understands that their only recourse is to foreclose and take the property back. And so they want to make sure that the property is going to earn the income that you say it's going to earn, that it's valued at what you say it's valued at. And typically they're going to want a larger amount down, usually anywhere from 40 to 60% down. but you still certainly can do it. And if you're interested in learning more about that, you can reach out to me. We can talk about it. You are going to find that most institutions aren't willing to do non-recourse financing. There are a few national lenders that will do it, and I always tell people to check with your local bank. If it's somebody you have a really good relationship with, they may be willing to do it as well. So before I get into the case studies, I wanted to explain a little bit to you about the differences in your options for the 401k. And a lot of times people are trying to decide between the two options because they're not sure whether or not they want to handle the record keeping themselves or allow us to do it. And remember at the beginning of the seminar, one of my key points was that it is very easy to self-direct and have checkbook control of your 401k. And of course, having checkbook control is going to make your investments very easy to do. You literally will have checkbook in hand. You can do deals over, coffee and a handshake if that's how you want to handle it. But you are going to be responsible for keeping track of money in and out of that account. You want to make sure that you don't commingle personal funds and retirement account funds. You want to make sure that you're properly titling all of your paperwork. And so there's a lot of things that go into record keeping. And I always remind people as well that we are professional record keepers. That's what we do. And so if you choose to have checkbook control of your retirement account, you're taking us out of our main role. And so you just want to make sure that you're keeping the types of records that we're keeping as well. And so your options for the 401k, the first option is going to be having us act as your third party administrator, meaning we're going to handle the record keeping for you, or you can do it yourself and be both the trustee and the administrator of that plan. And I have examples of both. And don't forget to get your questions typed into the question box as we go. We'll try to answer those questions. So my first example is going to be purchasing real estate through using Advanta as a third-party administrator. And it looks like we had a question pop up.
Yeah, the question is, can a person over 70 and a half also contribute to either simple or step IRA?
So the question was over 70 and a half. Remember again, that's required minimum distribution age. If you're over 70 and a half and you have earned income, could you contribute to a SEP or a simple IRA? And the answer is yes. You'll still have those required minimum distributions, but you can certainly make those contributions. So I'm going to give you an example of how it works with Advanta IRA as the administrator. And so Larry is going to be our subject here. He establishes a solo 401k with Advanta as the administrator to purchase real estate. So let me walk you through the steps of how that works. Larry is going to first establish a solo 401k account with Advanta. What that means is he's going to fill out our application packet. We're going to have some questions for him, who's sponsoring the plan. And again, remember at the beginning, we talked some definitions, and the sponsor is either Larry as the sole proprietor or Larry's business. It will depend on how he files and how he pays himself. Larry will act as the trustee for his 401k, but Advanta will do the record keeping. So we're the administrator and Larry is the trustee. Most of the time, for those of you that are not familiar, the account holder is the trustee of that account. So that means that Larry will always sign all of the investment documents, and Advanta will simply be there to help him with the record keeping on those documents. So Advanta IRA will go over the options of funding the account with Larry. So we're going to talk to Larry and say, where is the money coming from to initially fund this solo 401k? Many times people have an old employer plan or an IRA that they want to roll into a solo 401k, which is absolutely possible. He could also simply be making an annual contribution. So we'll talk to you about that. We'll find out how you plan on making that contribution or moving that money over. And from there, we'll give you guidance on how to get that money into the 401k account. And remember, in this example, we are holding the checkbook on Larry's behalf. So that's the easiest way to kind of consider what a third-party administrator does. During the application process with Advanta IRA, Larry is going to establish a name for the 401k. So in this case, Larry kept it really simple. It's his initials, LS 401k. Larry is ready to buy real estate with his account. So Larry finds the property to purchase and writes the contract in the name of the 401k. He is going to include himself as trustee on those documents so that when he goes to sign anything, there's no question as to what his responsibility is and what gives him the allowance to do the signing on behalf of the 401. Larry will send the contract to Advana so we can confirm the contract is correctly vested in the name of the 401k, and we will also assist with the vesting for all the closing documents. And this is very important because the vesting on the contract and everything from contract to close is illustrating to the IRS that this investment is being made tax deferred through a retirement account. And so typically through an IRA, it would first show the name of the custodian or administrator and then for benefit of the account holder. So with an IRA, it would be Advanta IRA for benefit of Larry Smith, account number 1234. But in the case of a 401k, it's actually going to show, again, Larry Smith as trustee of, and then the name of his 401k. And then we typically will include the for benefit of Larry Smith on here. The reason for that is, let's say that Larry is married and his spouse is an employee of the business and she also participates in the 401k. Larry may still be the trustee, but in that case, it would be for benefit of Larry's wife's name instead. Larry will send the contract to Advana. We confirm all of the documents are properly vested, and from there, we'll have Larry sign all the forms as trustee, and we'll help him submit those to the closing attorney or title agency that is performing the closing. We'll have Larry complete 2 forms for us, giving us permission basically to fund the purchase the day of closing, and we'll go ahead and do that on behalf of Larry's 401k. After closing, rent checks will be written directly to Advana IRA for benefit of Larry Smith, and they'll come to Advana. Now, an important note on that, a lot of times people say, well, are you a property manager? And we're not. So we're not tracking down whether or not the tenants are paying rent on time, whether it's, on the 1st or the 3rd or the 5th. And a lot of times when we receive the mail here at Advana IRA, we receive it at nearly 5 o'clock. And so if it's received at 5 o'clock on the 1st of the month, it's not going to be deposited until the next day. And we're not keeping track of when rents are received. So what I always tell clients is you can certainly have a property manager, that will work, or you can pick up rents or have them sent directly to you. But the important thing is that the check is always made out to Advanta so that you can simply forward them on to us. You want to make sure that you don't take constructive receipt of those rents. And so once we receive them, we will deposit them. We make it easy to track deposits and withdrawals from the account via our online system and email. And then expenses are paid out of the 401k. And remember, again, in this example, we're the third-party administrator, so we hold the checkbook for Larry. So if he has any expenses that need to be paid, he'll reach out to us and ask us to pay them, or he can go on to our online portal and request a check to whatever vendor he might need. So again, very important flow of funds always in and out of the 401k through Advanta IRA. And that's same with future contributions. Larry is going to make checks payable to Advanta IRA. He's going to let us know how to deposit them, employee or employer contributions, and whether or not they might be Roth elective deferrals. We'll make those deposits to his account. And at the end of the year, he's going to have his tax professional help him file any tax forms necessary for the 401k. So in my next example here, I'm going to talk about checkbook control and how that works with a 401k. And I already mentioned that with an IRA, you can obtain checkbook control by the use of a single member LLC. So if you're looking for checkbook control with an IRA, you do have to form a separate entity in order to do that. But with a 401k, that's simply not the case. You can actually have a do your own plan, where essentially you adopt plan documents that already exist from Advana IRA, and from there open the bank account in the name of the 401k. So let's see what that looks like. So in this case, Larry, instead of completing an application packet, is going to complete the adoption agreement to adopt the 401k plan documents from Advanta IRA. Advanta IRA has IRS approved plan documents so that Larry is confident his plan documents are in good order and will be kept up to date. He will also obtain an EIN for the plan itself, and this is completely unrelated to the EIN for his business. So the 401k plan does have to have an EIN. That's going to help you in establishing the bank account. During the application process, once again, Larry names the 401k, LS 401k, with the adoption agreement. So that application that he fills out with Advanta qualifies as the adoption agreement and the plan documents. Larry is ready to establish a bank account for the 401k. So he's going to take all of that documentation with him to the bank in order to open the bank account. And the bank account will be in the name of the 401k, and that's very important. Remember how we talked in the previous example about vesting assets in the name of the 401k demonstrates to the IRS that this is a tax sheltered entity. The bank account for this 401k is going to be exactly the same. It needs to establish the 401k as the owner of the bank account. And so it can be a normal checking account, but it must be in the name of the 401k. And as I mentioned before, we typically like to see the account holder as trustee listed first, even in the bank titling, and then the name of the 401k. So Larry Smith as trustee of LS 401k. And, you know, Larry Smith as trustee just makes things easier for Larry because anytime he goes to deposit or needs to sign anything on behalf of the 401, he's already listed as trustee and just has to show identification rather than showing his 401k documents every time he needs to act as trustee. Larry will initiate the funding of the account and deposit any checks received by him to the bank account for the 401k. So what does that mean? Well, if Larry has that old employer plan that he did in the first example to move over to the 401k, as the administrator and trustee, he's going to request that the old employer plan administrator send him a check written to LS 401k, but where does it go? It's not going to come to Advanta because we're only supplying plan documents. So it's actually going to go to Larry, whether it's to his business address or to his home address, made out to the 401k, and then Larry as trustee will be able to deposit that money. He will also keep track of contributions made into that bank account. So if he makes the employer contribution and the employee contribution, again, he's going to just want to make sure that he's doing the proper record keeping for those. Larry will make investments on behalf of the 401k as trustee and fund these investments directly from the bank account. Larry will handle all of the record keeping for the account and file any required tax forms at the end of the year with his tax professional. Advanta IRA will keep the plan documents compliant and alert Larry if any changes are made for IRS purposes. Was there any questions? Yep.
What are the 2019 contribution deadlines for elective deferrals, employer contributions, and Roth after taxes?
Okay, so the question is on contributions. When are they due? What are the deadlines? And that's a great question. Again, if you have to have your plan established as of December 31st. As long as you do, your employee contributions, which are also the Roth elective deferrals, should be made in January. And the idea behind that being if you are on payroll, you know, a W-2 employee, your last paycheck may come to you from 2019 into January, but by the end of January, you should have made your employee contributions, and that includes the Roth elective deferrals. Your employer contributions can be made up until your employer tax filing deadline plus extension. So, you know, if you have filed extensions and you have all the way to September, October, as the employer, those employer contributions can be made up until that time. Okay, well, I don't see any other questions here, but if you guys do have more questions, you are welcome to reach out to me by email or give me a call. My direct line is 727-754-9963. Again, 727-754-9963. My name is Larissa Green, and I'm with Advanta IRA.